In today's video, we will discuss the market maker model strategy with an insanely high win rate and accuracy. If you are struggling to find a model to trade or looking for a strategy to pass your funding challenges, then this is the one. We will go through rules, time frame alignment, examples, and much more to ensure you understand everything. Grab your notebook, and let's get started. MMXM stands for Market Maker X model, and X could be sell or buy. So we have the Market Maker Buy model and Market Maker Sell model. This strategy is going to work for both intraday trading and swing trading with minor rule differences which we will discuss afterward, but it is going to work on every scale, whether it is scalping, intraday trading, swing trading, or position trading, because we know that price is fractal. But for this video, I will explain how you can use the Market Maker model to day trade and swing trade. Let's go ahead and look at the rules for day trading with this strategy. First of all, we have to make sure we have high impact news on the day. This is important as we need high impact news because it creates volatility in the market. You can use websites like forexfactory.com to look out for red folder news on the current week or the week ahead so you can plan your week. Days without the news are less volatile, and high-impact news makes sure that we will have a volatility injection by the algorithm which will make our trades hit their TP even more quickly and smoother. This is why people say to avoid trading on Mondays, as they usually have no news, and for that reason, Mondays usually consolidate. So that all being said, high-impact news is important, and we must have red folder news on the day. Also, remember that if you are an inexperienced trader, you should avoid days with CPI, NFP, and FOMC. These are high-impact news, but they usually create a tricky price action for a beginner. Moving on to step number 2, you must trade within the kill zones. If you don't know what kill zones are, it is basically sessions. These are also important as we have to ensure that we are trading the times when the market is volatile, as we know time is more important than price in trading. For the sake of recap, there are 3 kill zones. Asian kill zone, which is from 7 p.m. to 9 p.m. Then we have the London kill zone, which is from 2 a.m. to 5 a.m. Then finally we have the New York kill zone, which is from 8 a.m. to 10 a.m. Keep in mind that all of these timings are in New York local time, so make sure you calibrate your trading charts to Eastern Standard Time. After that, we have to have some kind of context for the trade, what the price is doing on the higher time frame. Because remember that without the context, you are just trading retail patterns which always fail in the long term. For this, we will be using monthly, weekly, and daily time frames. We will start on the monthly time frame. If it is not clear, then we will go to the weekly time frame, and if that is unclear as well, then we will go to the daily time frame to look for the context. If daily is unclear as well, then we will stay out of the market until it is clear. We will be using IRL to ERL and ERL to IRL concepts to get our context. Or you can say bias or draw on liquidity. It is one of the most important steps and skills while trading. If you don't know bias and context, then you are just gambling. You can check my draw on liquidity video on my channel after this video if you haven't watched it already. It will help you a lot with this strategy and in trading ICT overall. Moving ahead, then we have to look for higher time frame PD arrays like fair value gaps displacing outwards of the context area on a 4-hour or 1-hour time frame. It will all make sense in a minute when we will look at our examples. Then finally, we will take our entry time on smaller time frames like 15-minute or 5-minute time frames. It is the easiest step among these steps. Before going ahead to our examples, let's also discuss the rules for swing trading. They are similar to day trading rules with minor tweaks. First of all, we must have a high impact news on the week to ensure that the week is not going to be a consolidation week. Secondly, we must align with the higher time frame order flows such as the monthly, because we have to trade with the higher time frame trend. As they say, the trend is your friend. It will help us filter out the low probability trades that are against our higher time frame order flow. After that, we need context and draw on liquidity to know where the price is heading. Again, IRL to ERL and ERL to IRL on a monthly, weekly, or daily time frame. Then we need to see a higher time frame PD array displacing away from the context area, preferably on monthly, weekly, or daily time frame. Then finally, our entry will be similar to day trading but on a larger time frame, as we are swing trading, preferably on 4-hour or 1-hour time frame. This is the time frame alignment that we will be using. If we are trading off of a monthly PD array, we will be looking for a market maker model on a daily time frame. If we are trading off of the weekly PD array, we will look for a 4-hour model. If we are trading from the daily PD array, then we will look for a 1-hour market maker model, and so on. Now let me show you some trade examples for swing trading and day trading. As I said, they are the same with slight changes. For a day trading example, here we are on AUD/JPY. Firstly, we will be looking at the monthly order flow, whether we are bullish or bearish. If we look over here, you can see we were quite bearish for some time, but we have recently switched to bullish order flow. We created the market structure shift, and the price also respects the bullish PD arrays. So we have a bullish order flow on a monthly time frame. Now we will jump to the weekly time frame to find our context, as we have no PD arrays close to the price on the monthly time frame. Looking at the weekly time frame, you can see price has recently taken out the external range liquidity. And we know for sure that after taking out the ERL, the price targets the internal range liquidity, and we can see that we have a fair value gap over here that we can expect for price to trade into, where we can potentially take trade from and target the external range liquidity again at the recent swing high. As I showed you in the time frame alignment, once we have the weekly PD array, we expect to see market maker model on the 4-hour time frame. So we will go down to the 4-hour time frame and wait for the price to trade back into the weekly fair value gap. As you can see, we have tapped into the higher time frame PD array and rejected it immediately, which is also a strong rejection on the weekly time frame. Now we will wait for the market structure shift after the price closes above the recent swing high with the body closure. Alternatively, you can also use change in state of delivery to confirm that the market will now switch its direction. It is basically when we disrespect the bearish PD array with displacement and create a new bullish fair value gap as well. You will see what I mean in a minute. Over here, you can see we create a new fair value gap with displacement. So we have a fair value gap in the PD array and a fair value gap out of the PD array. If you find that complicated, you can stick to the using market structure shift. Now we will drop down to a 15-minute time frame to find our entry. You could have also taken entry directly on the 4-hour time frame if you were swing trading. Now on our entry time frame, we will also wait for a potential bounce out of the 4-hour fair value gap. You can see we have tapped deep into the fair value gap, which is looking like a rejection on the 4-hour time frame as well. Let's wait for the change in state of delivery or market structure shift once again to confirm our bias so we can place our trade. Price has formed a fair value gap displacing away from the higher time frame PD array. This looks like a breakaway gap, which is when the price closes beyond the first candle high, and usually breakaway gaps are not traded immediately until we've taken out the external liquidity, so we will be looking for another fair value gap to form. We had our new fair value gap formed, which got tapped in almost instantly. But if we take trade from this fair value gap, our stop loss will be huge, and the risk to reward will be unhealthy. But if you look over here, we have taken out the short-term external range liquidity, so now the price is likely to trade to that breakaway gap that was formed earlier. I will place my limit order at the top of the breakaway gap. The stop loss will be at the low of this candle to get a better risk to reward ratio. You can place it at the swing low if you want to play safe. For target, we will be targeting the classic 1 to 2 risk to reward ratio. Let me place the order real quick and play the price ahead to see how it plays out. Price went down and triggered us into the trade. Shortly after that, price went straight to our take profit level with energetic displacement, giving us a beautiful 2-hour trade. Let's move ahead to our swing trade example. We are on a monthly time frame for Euro USD. We have been bearish for a long time, and we are also respecting bearish fair value gaps and bearish PD arrays, which suggests that we are bearish. We don't have any fair value gap on the monthly time frame, so let's drop down to the weekly time frame. On a weekly time frame, we have this fair value gap where we expect the price to tap into and take out this nearest swing low below, or possibly this swing low as well, but we will stick to the lowest hanging fruit. Let's go lower to the 4-hour time frame and wait patiently for the price to come to that weekly fair value gap. Once we have tapped into the higher time frame PD array, we will either wait for a market structure shift or a change in the state of character. We got our CISD over here after disrespecting the bullish PD array. So we have a fair value gap in and a fair value gap out of the higher time frame PD array. I will place my limit order at the start of the fair value gap. You can place your stop loss above the recent swing high if you want to be safe, or at end of this candle to save a few pips on RR. For TP, I will again target 1 to 2 risk to reward, which is more than enough to be profitable. Let me place my order and see how it plays out. Price tapped into the fair value gap, giving us our entry. After that, price went straight to our take profit. You can see how you can put everything together to get these accurate trades. I will suggest you backtest it before trading it in a live market. If you have any doubts, let me know in the comments section below. If you want me to personally guide you to profitability so you can easily pass your funding challenges and make profits consistently, check out the link in the description below to join the mentorship for exclusive content, strategies, and tools. All that being said, thanks for watching this video. I hope you achieve your dreams. See you in another video very soon. Peace.